Good morning, Bitcoiners. Hello and welcome back to another edition of your Bitcoin Economic Calendar, where we cover the news that you need to know for the week ahead in Bitcoin. Today is Monday, March 1st, and we have a jam-packed episode. In today's show, we're going to be talking about two very important macro indicators that can hold a lot of insights for future private spending. That is the activity in the housing market, as well as capital goods spending for businesses. We're going to get into why that is in today's episode. There's also a lot of talk about the yield on the 10-year Treasury bond in the US. There are several or meaningful implications of the real return of that bond yield going positive. And we're going to talk about what happens when that occurs. And lastly, we're going to go over some very interesting insights from the upcoming Coinbase IPO. So without further ado, onwards to our analysis. Starting our analysis, as we usually do with Bitcoin, we see that it had a whipsaw week last week, and it was down significantly, closing the week down 21.31% at $45,240. As with most other markets, Bitcoin was down significantly. So we can see that it wasn't just Bitcoin that went down. It was the S&P, it was gold, Ethereum, DeFi. We'll be going over that in detail today. But suffice to say that Bitcoin essentially followed suit along with most markets. And somewhat serendipitously, the narrative or the focus around last week's price action in the markets was the yield or the rising yield on the 10-year US Treasury note, which we covered in depth last week, highlighting precisely the risk of that yield continuing to creep higher. Now, as we mentioned, the long-term implications of a rising yield on a 10-year note is inflation expectations, which are typically bullish for Bitcoin prices. However, the rising yield on a 10-year note does create a lot of headwinds for both equities and bond markets, and there's a knee-jerk reaction from some of the participants to trim their entire long portfolios, which can hurt most asset prices. So we saw some of that at play last week, including Bitcoin. We will cover at length more of this dynamic, but for now, we wanted to highlight a couple other very important macro indicators that can essentially signal the increased potential for upcoming inflation in the U.S. economy. So before we get into that, let's just talk about them on a high level. There are two very important macro indicators for future inflation, and these are purchases that lead to more purchases. So a good example of this would be purchasing a home. Typically, when you purchase a home, there's future spending to be had to equip the house, etc. And similarly, when a business spends additional money on capital goods, typically they will need more staff, new facilities, etc. to operate those new assets. So that's why it's important to look at both the housing market activity as well as capital goods spending. So noting in the back of your screen here, you see that basically the US housing market is growing at double digits for the first time in many years. Now, combine that with the fact that the US savings rate for the private consumer is up at 20.5% for the month of January, and you have a US consumer that has a lot of firepower going into a potential reopening of the economy. Now, if we look at the business side of things, the headline that you have behind your screen right now, it's basically from last week that says for US businesses, it's time to spend. So capital good orders for businesses are also ticking higher, considerably higher than a year ago today. So with the Fed pledging to keep interest rates low and pushing for a return to full employment, there seems to be growing potential that the US economy continues to pick up steam. This will eventually put upward pressure on inflation, which is ultimately good for Bitcoin. We'll cover what we're seeing in the futures and options markets, as well as their perpetual swaps for Bitcoin in our What's Ahead section later today. Moving over to the S&P 500, as we covered above, most markets came down last week due to the increasing yield on the 10-year Treasury note. So on the S&P side, it was down 2.34%, closing at 3,812 points. This dynamic of basically headwinds in markets when the yield on the 10-year Treasury note rises happens for several reasons. At a high level, as we had covered last week, higher yields on these bonds mean higher borrowing costs for corporations, potentials for higher future inflation, and it also means a potentially stronger dollar. As we can see last week, because the yield on the 10-year was actually rising quite sharply, we see that the dollar also had a positive week, which, as we know, has an inverse correlation to how markets tend to perform. So just popping open the 10-year, the return on the 10-year note for a second, we can see here that this graph that you have behind your screen right now is the inflation indexed yield for the 10-year note. So as you can see here, what this means is that when you account inflation for the next 10 years into the implied yield for the curve, you can basically net the two out and you get the real return. So what are you earning after inflation? As we can see, what this graph is telling us is that the real return on that 10-year note, on the 10-year note, is actually still quite a bit negative, but it's quickly moving its way up to where it could be positive. So as we can see, it tends to trade on a positive real return. However, as of recently, it has not been doing so. So again, many implications of this turning positive, and we're going to go over those in detail. So when just to cover a little bit of that dynamic, when the real return on this bond went negative, it basically means that investors are getting less dollars than they're putting in, factoring in inflation at the end of the period. So this obviously drives a lot of investors to divest out of these types of bonds and invest into other more attractive options. So once this real return of this 10-year bond goes back into the positives, it could potentially become more attractive or make holding dollars more attractive and essentially cause a return to safety in the US dollar, and what could potentially take away some liquidity or some momentum out of other markets. So something interesting or important to keep our eyes on as this dynamic continues to play out. Now, the other interesting market event that's potentially at play is the stimulus package that Biden's administration is preparing to put forward. As we covered last week, it moved through the House, and now it's facing, or basically it's heading to the Senate this week. So it may find some pressure, as we commented last week. There were two Democrat senators that were voicing some opposition to moving this ahead. However, Democrats will need every single member of the party in the Senate to vote in favor of this. So there is some potential that there will be some debate, but likely the bill would go through, perhaps after some changes, which will essentially put the focus of market participants back on this fiscal stimulus that's hitting the streets, and what that will do to asset prices and the economy in general. We're going to be talking about this in more depth in our What's Ahead section later today. Moving over to gold, somewhat consistent with every other market and what we had written about last week, gold was unable to recover after breaking that very important support level that we were highlighting last week, and somewhat coincidentally actually went down to settle the week at $1,732, which was just $7 away from that support level that we had mentioned last week at $17.25. So very interesting price action happening here. Can't really say that it was not to be expected, given some of the trends that we had been seeing already. Needless to say, this does not make the gold chart look any better, and it will be interesting to see if it's finally able to catch some footing with this potential stimulus hitting the street, or if it continues to head further south. Considering other macro indicators that are out there, gold looks poised to continue underperforming Bitcoin in relative terms. Moving over to the Ftx Defa Index, we see that as with many other crypto markets, the Defa Index was down 19.81%, so just about 20%. We see that Ethereum also had a pretty bad week, down over 25%, and being able to close just above its previous all-time high, which is a positive thing from a technical standpoint. But still, it was significantly hurt, as was the DeFi index. Now, interestingly, there's a bit of a dynamic starting to play out between Ethereum and Binance Chain, with Binance's CEO going on the offensive. And here's, I'm going to pop out a tweet in the back of your screen right now, where Chapon Xiao, I believe that's how you pronounce his name, basically the CEO of Binance went out to say that Ethereum is a network for the rich guys, but soon those guys will be poor. Then he went on to say, I like ETH, I just don't use it anymore. Again, this is very interesting, not something that you typically see out of CZ, but it's definitely, putting out some hurtful words, I guess, towards Ethereum, and there seems to be some some debate starting to brew between the two camps. Now, while competing smart contract chains or protocols is not a bad thing for DeFi in general, given the current network effect that Ethereum has, any significant down price on the Ethereum asset at the protocol level will impact significantly on DeFi protocols, as Ethereum itself is used as collateral for many of these protocols. And when ETH goes down, the value locked in these protocols also drops, causing investors to also want to sell their tokens. So interesting dynamic to keep our eyes on for the next week. Moving over to our Bitcoin mining difficulty commentary, we see that not much has changed on this front. We're still scheduled to have the next adjustment come in this upcoming Friday, and it should bring the difficulty level down just a touch. On the mempool side of things, it has not gotten any better. In fact, the mempool went up considerably last week and is currently sitting around 80 million bytes. This means transactions are taking longer than normal to get confirmed, and it will probably be more expensive than usual to transact on the network. This type of network congestion is typical during volatile price moves, so do plan your transactions accordingly. So as always, we leave you with what's ahead for the week. As we mentioned, there are two very important dynamics at play right now. One is what the rise of bond yields or interest rates will mean for US companies and the US consumer. And the second one is what will the downstream effect of stimulus spending and pent-up private spending in the US will do to the US economy. To cover the first point, there are real implications of the real return of the 10-year Treasury note going positive. As we covered above, many investors sold their bonds or sold their dollars because of the negative real rate of return. They would get less dollars than they would put in at the end of the 10 years. This drove them to make a flurry of investments elsewhere, essentially. But as the return of holding dollars goes back to a positive real return, this may suck liquidity away from other markets. On the second point, the economic indicators are pointing to a very strong balance sheet at the US consumer level. Indicators of future spending, such as the housing market and capital goods orders, are looking better than they were at the pre-pandemic levels, which is causing a bit of a perfect storm for future inflation expectations. So, where do we go from here? It really depends on the Fed. In his most recent appearance before the Senate Banking Committee last week, Fed Chairman Jerome Powell stated that there's still a very long way before the US economy reaches full employment. This is the Fed's main driver to keep interest rates low and support fiscal stimulus. Now, in addition to Biden's $1.9 trillion package, there's another $3 to $4 trillion infrastructure package in the works from the Biden administration due to the devastating effects that the winter storms have had in some of the US. Now, with so many factors pointing to future inflation, the narrative that the Fed may have to tighten monetary policy sooner than later continues to build. The Fed has been very, very vocal that they will not act or taper before inflation is consistently over 2%. So looking at the data, inflation for January came in at 1.4% annualized, meaning that the Fed still has a lot of room to go before it has to act. Looking back at the crypto markets, the Coinbase IPO draws closer by the day, and insightful information continues to surface. For one, they have left the door open to potential token offerings, and interestingly, its valuation is rumored to be close to $100 billion when it comes to its public listing. To put things in perspective, Goldman Sachs has a market capitalization of $110 billion. This would make Coinbase one of the most prestigious financial institutions in the world by market capitalization. This could be seen as a sign of changing of the guards for traditional finance. Lastly, on the futures and options world, we see a healthy contango on the futures curve, tapering at the $51,000 level in June. And on the options front, we're seeing some interesting open interest at the $100,000 strike for the March 26th options expiration. And to comment on the perpetual swap funding rates, we've seen that the recent downturn in prices has somewhat washed some of the perpetual swap funding rate premiums. With the perpetual swap funding rates for Bitcoin, while they're still positive across major platforms, meaning that there are more people long than short, these funding rates are considerably down from their 30-day moving averages, which is typically a healthy sign for a market going into the week. So, as always, we will keep you posted and share any relevant information right here on the economic calendar or through our social media accounts at Hodl with Ledin. If you don't yet have a Ledin account, I welcome you to check out ledin.io and learn how you can start earning 12.5% on your USDC and 6% on your Bitcoin. If you like something, or if you like today's show, if you learned something, I invite you to subscribe, share it, and like the episode. Thank you so much, everybody, and see you next week. Have a wonderful